Live from the McNeil International Film Studios in beautiful Baja Tustin, talking about international trade and finance, it's not Cher on her third farewell tour, it's Professor Mark McNeil.
I'm sure that means something awful, but I don't know what. All right, this is international trade and finance. I may have to break up this video into trade and a separate one in finance. If it does, we'll just break it up. It won't go so long then. Okay, here's the big deal. The big deal is international trade. All over the world, everywhere, in ports, there's just fabulous amounts of stuff coming into ports and being distributed everywhere. There are containers going from one side of the world to the other. The amount of trade that goes on in the world is unbelievable. And the thing about international trade is that it takes place between two different groups who have different laws and different currencies. And so that makes it different, and it has effects we'll talk about. So international trade and finance, very briefly, I mean, it's a giant subject, and I'm going to try and hit the high spots here. So first of all, the scope of international trade, it is everywhere. It's all over the world. I mean, just be aware a little bit of the normal things you touch and handle, and how these things have come from halfway across the world. It's amazing. Why trade? And the answer is why international trade takes place is exactly the same reason the trade between a farmer and a goldsmith takes place, because wealth is created. And in your life, everybody in every country and every city and so forth has their own production possibilities frontier, which defines the limits of what they can produce. But eons ago, humans figured out that people have their comparative advantage. Some people can do lots of one thing and not much of another, whereas another group of people can do a lot of what the other one does a little of, and a little of what the other does a lot of, which means the costs of producing these things are different. And as a result, when these two groups of people get together, they find profitable trading opportunities. As long as the costs are different, there are profitable trading opportunities. And when groups of people specialize in trade based on the principle of comparative advantage, this is their own consumption possibilities frontier, but their production possibilities frontier lies well beyond that, so that people are limited in how much they can produce. They cannot produce outside of their production possibilities frontier, but they can consume out of it if they specialize in trade based on the principle of comparative advantage. So it's a simple example, but if you have country A and country B, and they specialize in trade, the world's production possibilities frontier can be much greater than either of these separately. So there's real wealth to be made, and in the world there is just staggering amounts of wealth that comes from international trade. And not only that, but within each country, workers that were working to produce low value things, or who were relatively unproductive, can shift into much more productive things. And it turns out that workers' wages and living conditions depend on productivity. So when workers move into higher productivity areas, their wages and living circumstances improve as well. So it's just wealth all over the place. But trade is restricted a lot as well. We'll talk about why. But trade restrictions come in two categories. One is tariffs. A tariff is a tax on technically imported and exported goods. Whereas there are non-tariff barriers as well, like health and safety rules, or I don't know. There are all sorts of tricks to reduce trade. But always, when free trade takes place or when trade is restricted, there are groups that benefit from it and groups that are harmed by it. There are winners and losers. So oftentimes tariffs or these non-tariff barriers are ways for people to seek rent. Now, rent in economics is not paying your apartment fee. Rent means getting money beyond what the value of your effort is worth. That is, it's free profit because you've figured out some way to create something unique, or more frequently, to get a government agency to protect you from competition so that you can raise your price. And this tariffs almost always represent a transfer of wealth from politically less powerful groups to politically more powerful groups. If you're curious about this, you should see the story of the sugar tariffs and quotas in the United States. They were just redone, and hundreds of millions of dollars go to, I don't know, 30 families or something in the United States. They make lots of money from these, and all people who use goods that have sugar in it pay for that. So the United States pays roughly double the world price for sugar so that this group of people can be better off. It's clearly a government-sponsored wealth shift from less politically powerful to more. So you say, okay, well, you know, there's always costs and benefits, so what if we put tariffs on lumber, on luggage, on sugar, on peanuts? Jimmy Carter, President Carter, was a peanut farmer here. In any case, you say, all right, we'll save jobs. We'll save jobs if we put a tariff on it. Great. How many jobs do we save, and how much does each of these jobs cost in terms of higher prices to consumers? And the answer is that in the jobs saved in the luggage industry, each job saved cost consumers $1.2 million. In the lumber industry, it was $1.044 million for each job saved. We would have been clearly better off to simply put a little tax on luggage and lumber and these other things, and use that money to just pay the people who lost their jobs to stay home. We would all be better off. But that's just not how it works. Anyway, peanuts saved jobs, and each job was cost $187,000, and this is like 15 years ago or so. So the jobs saved were like from $30,000 to $50,000 each. So there are all sorts of stories about why we should restrict trade, why we need to put tariffs against other countries and production and so forth. So, well, jobs. You know, if we get competition in this industry from China, for instance, then there will be fewer jobs in the American industry because of the competition from the Chinese imports. Well, okay, but first of all, jobs are not the point to economic activity. It's easy to make jobs. The purpose of economic activity is to be productive. And jobs saved is, in the long run, trade affects wealth. It does not affect employment. I realize there are short-term effects on employment, but in the long run, the employment is going to be roughly the same. It's just the wealth will be less if we restrict trade. National defense, dollars lost, like we run a trade deficit with the rest of the world of $800 billion. This is dollars lost. Infant industries, these are all nice explanations, but they don't hold water for the most part. They all cost more than they're worth, and a lot of them are just bogus. You got to remember that in the long run, trade affects wealth, not employment. There are short-run adjustments to deal with. I agree. Now, net exports is equal to exports minus imports. And net exports is a term in aggregate demand. So when we look at this relationship, well, look at aggregate demand, the relationship between the price level and real GDP, aggregate demand is made up of consumption, investment, government, and net exports. So what would cause a change in net exports? And the answer is when exchange rates change, that would cause, because if exchange rate changes, if the exchange rate changes, then country A's goods are now more costly to country B and they buy less, and country B's goods are cheaper to country A and so they buy more, and that will change net exports. Relative income changes. When incomes rise faster in one country, those incomes are going up people buy more goods, not just domestically produced goods, but also imported goods. Preferences. Sometimes people in country B just like country A's production, sort of like America with German cars or something. And when those preferences change, it changes net exports. Trade policies. The United States has a trade war with China. That can affect net exports. I think it's not a giant thing, but it can affect it, definitely. And relative price level changes. If country B's prices rise very quickly, country A will start buying less of it, and that will change net exports, and the exchange rate will have to change, and so forth. So here, given the foreign exchange markets where dollars are exchanged for SOCs, SOC stands for some other currency. There are only two currencies in the world, the dollar and the SOC. There are only two countries in the world, the US and SOC, which is some other country. I realize I've simplified the world a good bit. So in this, in the foreign exchange market, FX stands for foreign exchange, we have the supply of dollars and the demand for dollars. So it turns out that if an American person wants to buy SOC goods, services, or assets, they first have to buy the currency to make that exchange with, or somebody has to do it on their behalf. So in order to buy SOCs, Americans have to sell dollars. So the supply of dollars in this foreign exchange market, it's the way I've set it up. This is the rate of SOCs per dollar. This is the dollar foreign exchange side of this market. The current rate of exchange is 3 SOCs for $1. That's the exchange rate. That's the original one here. And if Americans want to buy more SOC things, the supply of SOCs in the foreign exchange markets will increase. And that will cause the exchange rate to change from 3 to 2. And always, when the exchange rate changes, one currency appreciates and the other depreciates. So in this case, when the exchange rate dropped from 3 to 2, the value of the dollar against the SOC depreciated, and the value of the SOC against the dollar appreciated. So the supply of dollars in this market depends on U.S. people who want to buy SOC goods, services, or assets. The demand for dollars in this foreign exchange market depends on foreign people who want to buy U.S. goods, services, or assets. So you have to be clear, what does the supply depend on and the demand, and that this is the dollar market where SOCs are exchanged for dollars at a certain 3 SOCs per dollar rate. Now, if this happens, if the value of the dollar depreciates against the SOC, it means that to U.S. people, SOC goods are more expensive now. It used to just take $1 to buy 3 SOCs worth of stuff, but now $1 only buys 2 SOCs worth of stuff. So the same things are more expensive to Americans. The same SOC things are more expensive because the exchange rate has changed. And so Americans will have fewer imports from SOC, but SOC people, it used to be that $1's worth of stuff cost them 3 SOCs, but now it only costs them 2 SOCs. So American goods are cheaper to SOC people. And so U.S. exports will increase, and imports will decrease, and that means that net exports as a term will increase. And when net exports increases, that's a term in aggregate demand. Aggregate demand will shift to the right. This will put upward pressure on price level and cause real GDP to increase a bit as well. So those are the foreign exchange markets, how they work. This is appreciate, depreciate. The supply of dollars depends on this. The demand for dollars depends on SOC people who want to buy U.S. goods, services, or assets. And in the long run, trade affects wealth, not employment. All right. The next topic is the international accounts. And I think it's a good time to take a break, because with the international accounts, we talk about international finance. The previous stuff was largely international trade. So I'm going to take a little break, and be right back with you to talk about international finance.